So I think the organizers do it on purpose to put the Greeks last, because we yell, so that you can hear us pretty well. So I apologize if you will find me yelling. So this is joint work with Nadav and Zeev and Elena Scola Gagliardi, who is a PhD student. And what we want to do in this paper is that what you have been asking yourself yesterday and today. So we have seen many times these graphs in this conference. So we have seen it yesterday during the panel discussion. And we have discussed the fact that in most countries, developed countries, we have observed this fall in defense spending, this negative trend in defense spending. And I would say I'm very happy about that. I would like to finish my talk here and go home. But unfortunately, that's not the case. What we see now is Rearm Europe, Readiness 2030, activation of GDP, GSP escape clauses, big programs for reinforcing the defense industry in Europe. And then we see also the support of the European Investment Bank towards military investments, and also individually in different countries. I think these things that we have already seen yesterday is that we see the Bundestag approving like the escape clause, which is something like that you don't see very often, Bundestag doing this stuff. And also like the NATO also supporting this increase in defense spending. So, and if you look at the European Commission, they have, like in their leaflet, they have a sentence that says, fully leveraging these financial tools will have positive effects for the EU's economy and competitiveness. So this is what the European Commission says, and we are like asking exactly the same question. So this is not actual defense spending. Defense spending has not happened yet, or like it started happening. The issue is how this news about defense spending can affect the European economy. So that's what we are going to ask in this paper with Nadav and Elena. So we are not having data, so we are going to draw inference from long historical data for Europe on defense spending, and we are going to use annual data for many Western European countries, and we will use data back to 1960s. And in order to be able to draw inference, what we're going to do is that we're going to use a panel structural vector autoregression. So, you know, I am back, Roberto, to SVAR. I didn't abandon them for local projections yet. So, and what we're going to do is that we will identify in these structural vector autoregressions, this panel data for different European countries. We have 17 countries. These defense news shocks. So the defense news shocks, I'm going to identify them by using medium run restrictions. What does this mean? You know, usually we use the Cholesky to identify shocks in the VAR by saying, okay, look, we will assume that government spending doesn't move today. That's what Roberto's work is about. Then there is another type of restrictions that we use that we say, okay, if we identify a demand shock, then output and inflation should move at the same time. So this is sign restrictions. Now, the maximum forecast error variance restrictions, they are putting restrictions in how the shock explain the forecast error variance of the variable of interest. Now, for this identification to make sense, I need to have a variable that I should think is exogenous. So as a result, I think that military spending is exogenous. Like, I don't think that we go like to spend on military spending because like we are like in a recession. Maybe in the US it can happen, but like in Europe, I think that it happened less. And then the other important assumption is that, okay, I will assume that the shock, the innovation I'm trying to recover is maximize the forecast error variance of defense spending at some horizon, 5 years, 10 years, but at the same time will not affect defense spending today. So my basic specification is going to be just what I told you. Then, because some people are incredulous, I'm going to also show you results in which I am going to also cut these shocks from any other kind of shocks that might affect output contemporaneously, and I will explain you why. So we started this paper because we wanted to make a methodological contribution. Why? Because we are in Europe, and most of the times we take inference using US data, and we say, oh, okay, defense spending can have these effects, look at the US. No, we have data, and our contribution here is mostly methodological because we want to use this European data. So we have this annual panel for a long period. So we want to extend these medium run restrictions, these forecast error variance restrictions, to a panel and use European data in order to draw inference. And as we can do that with defense spending, maybe future researchers can do it with other types of shocks that they could be news about the economy. So that's what we are trying to do. Let me tell you the findings. News are good. This defense spending should work. Actually, they're going to stimulate output, consumption, and investment, and employment. The output multipliers are large, like they are for Roberto, and I'm sorry, I have tried everything to bring them down. I'm still trying, but they're big. So, what I'm going to show you is that they're also larger from the US. And one would be like, okay, but in Europe, the R&D in Europe is very small. Like yesterday we were saying 1%, 2%. But you have to understand that in Europe, I think the mechanism is different. In the US, the defense contractors are like firms that they just produce missiles. In Europe, we have this dual technology. Like Leonardo or Airbus, etc., they don't produce just missiles or just planes. They also produce goods that actually we consume. And maybe this is the spillover that we have in Europe that the US doesn't have. So anyways, we will see that later. The other thing that happens is that in Europe, what we have is that the military spending is actually crowding in government investment, and it's crowding out other types of government investment, which is probably productive. I'm from Greece, I know about that. So all good, but there are going to be some losers, and the losers are going to be the workers. Why? Because we show that defense news can actually increase income inequality. In other words, if I would look at gross operating surplus, that I haven't done yet, we haven't done yet, we saw that this kind of increases. So it is going to go to the firms at the end. Now, I'm not going to go to the related literature because I have Ethan here as a discussant, and he has a paper where he relates everything about military spending, so I leave it up to him. And I will just tell you that this paper doesn't come out of the blue. I have worked with Nadav in a previous paper on this defense news in the US. So this is like a natural extension of the methodology we have used there for Europe. So let me explain you the methodology as much as I can and in little words. So what we're going to do is that we're going to have a panel where we are going to put the macroeconomic variables of each country, and then we will assume that this vector of variables for each country will follow a law of motion that will depend on past information about the economic condition in this country. Then we're going to have fixed effects, mean effects that they're going to be country-specific. You don't see the thing I know. And then we will have a shock, which is going to be the reduced form shock. Forget about the details about d-means, etc. We can come back to this later. So now this will give me the law of motion of the economies that we have in the panel, given these reduced form shocks. But these shocks are correlated. I need to have a structural shock. I want to identify something that will be kind of, exogenous, and I can call it defense news shock. So the way I'm going to go about it is that I will transform this reduced form to the structural shock, and I need to use some kind of restrictions to be able to call it structural. So what I'm going to do is that I will take the 8-step ahead forecast error of this VAR that I'm using, and I'm going to write it in a format in which I will be able to look at this forecast and try to maximize the forecast error variance at this horizon that I want, which is 5 years here. So I am actually using this methodology, try to solve this optimization problem by choosing the optimum gamma. And here, the restrictions that I'm going to impose is that this shock is going to be orthogonal to the first element of the matrix, which is going to be defense spending for me, and the second is going to be the news. And then I also normalize that it is going to be equal to 1. Okay, so now it is even going to be more science fiction, but basically we're going to estimate this using Bayesian estimation and inference. And what we are going to do is that we're going to assume a normal inverse Wizard prior, like the Jeffreys prior. Now, I'm not going to talk to you about the details. This is like a long procedure. What I want you to notice is that we are going to apply a sandwich estimator. It's very nice. I have heard about donut estimators. Now we have also sandwich, where we want to make sure that what we're going to get as inference is going to be like robust. Now, you understand what I'm doing there. I have different units, different countries, and I'm pooling them together. So what I want to make sure is that my pooling is not pressuring the countries to give me the same answer. So when I'm going to interpret my estimates of the pool estimates I'm going to get, what I'm going to think about is as the effect that I'm going to present to you today is going to be a weighted average of what defense spending would be for each country. Okay? So, good. If you understood that, then I am not going to go to a lot of details. Data, 17 Western European countries. You know, we have data which is an unbalanced balance. So we have Belgium, France, Italy, United Kingdom. They start in the 60s. The rest of the countries starts in the 70s. We have annual frequency. The data from defense spending come from the CIPRI, which is the Stockholm International Peace Research Institute. And the macro data come from AMECO. So this is a very European project. So without further ado, let me show you the responses. I apologize for the many graphs, but just follow me. So what happens is that I have identified this defense news shock. So this shock, by definition, should not move defense on impact. So what I see is on impact, you see the left upper panel is defense spending. So it doesn't move at all. It moves through time, and it goes to a maximum around 6 to 7 years after the shock. Now, besides the fact that the defense spending is not moving, output is increasing significantly on impact. The same happened with consumption, which is next to output, and to investment, which is just below defense spending. Now, employment is also increasing with a little bit of a lag, and I see a fall in the real wage. We explain in the paper that this is not actually robust. And I see a little bit of inflationary effect, not too much, just on the impact period, and an increase in the interest rate, which is kind of compatible with the fact that I have an increase in demand. Now, I need help from the people there. Can you please check the GPR thing? No? I just wanted to show, yeah, the GPR, there, that's good, that's good. So, I mean, we're talking about defense spending. I am using a very statistical method to identify these shocks. So I want some kind of external validity. How can I do that? I say, OK, look, I have identified my defense spending the way I did. Let me see what happens to the global geopolitical index. And you see, besides the fact that I didn't put any restriction there, you know, it increases significantly on impact. So I do identify something that looks like defense spending. Can we go back? OK, good. All right, now I will handle. So if we look at multipliers, we see that multipliers in Europe are much higher than the ones that we report in the US. And we have many multipliers in the paper. Maybe Ethan is going to talk about that. But what we see is that we have multipliers that they're high, and they continue to be high. Now, how is the propagation mechanism? So one thing to notice is that our shock is increasing significantly and persistently on the right-hand panel there, government investment. So what I am doing in this slide is that I run a different VAR in which I augment the benchmark with government investment series. And what I see is that in response to my shock, you see the rest of the responses do not change much. The government investment is also increasing significantly on impact and persistently. Now, we think, okay, where these effects come from? So we want to investigate how much of these effects that we report are coming from a supply side channel. So I have an increase in defense news. Can I consider that this defense news are going to bring more R&D? So what happens to TFP? So we're looking at the effects of the TFP that comes from the world tables, which is not perfect, it's not utilization adjusted. But still, we're like, okay, let's look what happens to the series. So we run the same VAR, the same variables, and at last we put the TFP. And as you see, it increases significantly on impact. Then it was like, okay, let's, maybe this is not a good measure. Why don't we go to the European Patent Office, and instead of TFP, we get European patents. So that's next. And we see also a significant increase of patents after the identified shock. So all this is very nice. But as I said, they come for a cost. If I look at the labor share, I see a clear fall of the labor share after the shock. So it is not all roses. Guns bring also some inequality, which is not good. Now, the thing is that if you are incredulous, you will be like, Evie, you know what? You go there, you take the data, and you try to make the most out of them. And you maximize the forecast error variance of defense spending. And by doing that, actually what you do with your methodology is that any shock that moves defense spending in the future will come out as a defense spending shock, as a new shock. But maybe it's not. Like, think about if you have a fiscal rule in which output is a certain fraction of output is actually going to defense spending. Like, let's say that this is done by 2%. So then what you're doing is, like, if there is a relationship between output and defense spending, you are calling me something defense spending when this is just like nothing. It's like movements in output. So here what I am plotting is the cross correlations between defense spending and output for blue line, big 5, not big 4, big 5. Then green line, all the countries in the sample, and red line, the US. So contemporaneously, I don't have an issue. I have an issue in the lags because it looks like that the output is actually, current output is actually predicting defense spending. So somebody will come, and rightly so, and will say, look, Evie, I think what you're doing with your identification is not very good because maybe what it is there, it is some output shock that you're calling defense spending by saying that it maximizes the forecast error variance of defense spending in the future. So maybe I get richer and I have more money, so I spend them for defense because I think that they're going to attack me. And then this results as a defense spending shock. So, I mean, we can do something about that. And what we're going to do is also trying to catch many birds at the same time, is that somebody else of you probably will tell me later, but I'm trying to anticipate, because the paper is about anticipation. Is like, okay, but you put all these countries together. You didn't tell that to Roberto, but you can tell it to me. So I'm like, okay, let me put a unified number of countries. So what I'm going to do, I will take the big 5. They look very similar. They have a similar industrial production, blah, blah, blah. And moreover, I have very reliable series for TFP that come from a recent work that Antonella Drigari, my friend, with other people from the Bank of Spain have launched. And I encourage you to look at them. They're both quarterly and annual. So I'm going to use a better series for TFP, and I'm going to use only these countries. And what I'm going to do is that I'm going to kill completely the TFP responses. And because you might also tell me that, you don't put any fiscal measure there, maybe we see an increase in government spending, but then we have at the same time a fall in taxation or something, I will put their public debt to GDP. So you're tranquil about this as well. And maybe you will tell me, yeah, but you know, commodity prices can also affect output. I will also put commodity prices and make sure my shock is orthogonal to commodity prices as well, okay? And that's what I'm going to do, and here's what I'm going to get. So I have the increase in defense spending. I mean, obviously now I look at a different sample. My sample starts in 1995, different countries. So, but still, the defense spending increases with a lag. Output reacts positively on impact, consumption as well, investment as well, employment. Debt to GDP actually is falling because of the increase in output, and I have the same effect that I showed you before. If I look in terms of multipliers, this is the dynamic multiplier. You see it is still positive, and is positive like in the short to medium run. So if you were worried that this was an artifact of my methodology, now I hope you will go home and sleep better, as I do. Now, given that I have these countries and I have killed completely the TFP effect, I still see positive responses to defense spending. So I want to understand where are they coming from. So what I will do today, because my co-author, you know, these programs, you have to understand this posterior estimation of Bayesian, it takes forever. So he didn't yet got the results. So I present you what he got, okay? And this is preliminary. Maybe at some point we have to refine them. So I'm going to look at government spending, and I'm going to see the components. So for these big five, what I see is that government investment still continues to increase with the shock. Now, if I look at general government, which is you have to concentrate always on the right bottom, okay? When I put government spending in the VAR, you see this is not moving, and if anything, it's falling, which means that there is a crowding out. So government investment comes in with defense spending. Total government bill doesn't change, which means probably they cut on the ladies that you go there and they are fixing their nails, which is not a big thing, which is not a bad thing, I mean. So maybe the effects that I find from government spending come from this crowding out. The other thing that we want to investigate, we haven't done yet, is that we want to look at industrial production because of this dual technology in Europe and see whether we see in sectors like the automotive industry, we do see bigger industrial production or bigger investment in this industry than in the rest. We haven't done it yet. And I have to also apologize because these results, Ethan didn't get them, so he got only the first ones. I hope it's okay. So let me conclude. Defense spending news can actually stimulate the economy. They work both through a TFP channel, but I cannot cut my hands on that. They also work through the crowding out, and there I can cut my hands if you want. And it is relevant, and it can work for Europe. It can work for, it is a winning strategy. So let's take this positive message. Today, St. Nicolaus are bringing a present to you. And the other thing that we have to notice is that it is also working right now as we talk. I went to the German statistical office. You know, Germany had negative growth rates of output until now. Now, defense spending news come, and the third quarter of 2025 is already positive numbers. So it is happening, all right? So I will leave you here sometime before my time has finished. I would like to thank you very much, and I'm very looking forward to your discussions.
Thank you. Well, thank you for inviting me, and thank you, Evie, for the really good and important paper. And I am well aware that I'm the last thing standing between you and lunch and getting to your flights, and so I'll try to be brief. I mean, this is a very nice paper. As Evie mentioned, I wrote a review article earlier this year trying to summarize what we know about the macroeconomic effects of defense spending. I'm now working on based on that paper, a article for the Annual Review of Economics that, given which will probably be quite different because there are so many people doing excellent work on it this year. But when I wrote the paper, I really was confronted with the challenge that most of the evidence we have is from the US. And so, when you're trying to give advice to European policymakers and you say, well, the Korean War stimulated economy through this channel, and they say, well, I mean, this is not the Korean War. And so it's really, really good and very important too to have more knowledge on Europe, and certainly in this review article, both the current and previous work of Evie and Nadav will feature prominently in them. So what do they do? I think Evie explained it very well, but let me just kind of recap. So it's a European panel vector autoregression. We'll talk about the methodology in a moment, studying the effect. And what's interesting here, and as Evie said, very relevant to current circumstances, that they're looking at defense spending news and not at the ultimate spending, only at the ultimate spending itself. Which is quite relevant to what's happening in Europe now. And they find, quite consistent with Roberto's findings, a relatively large multiplier on military spending and driven by TFP growth. It builds on previous work by Evie and Nadav in the US and other papers. But yeah, so, okay, Evie talked a little bit about the identification, but let me give kind of the methodological contribution here. So the earlier contributions really that use structural VARs to identify fiscal or other shocks used short-run identification, either through timing restrictions, as in Roberto's work with Olivier Blanchard, or finding some instrument to these residuals from a vector autoregression forecast of these shocks. There's a separate literature that looks at kind of asymptotically where these shocks go to eventually, as in Blanchard and Qua's work that tries to separate demand and supply shocks along the business cycle. This paper contributes, and this really is an important methodological contribution to try to identify fiscal shocks through trying to match the path or to maximize the ability of the VAR to the shocks to forecast within the VAR the trajectory of the variable of interest. So essentially, the VAR is giving you these forecast errors, these residuals, and you're saying which combination of these residuals, except for the defense spending shock, is going to best predict defense spending in the future. Okay, so I think this is quite an interesting way to approach it, and I think quite useful. Okay, so now it's my job to also comment on the paper and make some observations. So number one is on the mechanism. I am very sympathetic with the mechanism that defense spending can contribute to TFP growth. And if we want to kind of see recent things, we have here, Leonardo unveiling an AI-based Iron Dome over Europe. And so, we're seeing innovations in real time and actually really quickly relative to the news. We see that is a picture from Helsing, an AI drone company in Munich. Also seeing, it's been active since 2017, but now really ramping up its production since the war in Ukraine. And at the bottom here, you can see these army of drones in Ukraine, and those bar charts are showing you might not be able to see it, but 2023, 2024, 2025, the number of drones produced in Ukraine. Ukraine moves from essentially producing no drones to now producing so many drones that it's actually producing more than Russia and exporting drones while it's at war. So, this is quite a remarkable increase and must be associated with massive productivity growth, at least in that sector, if not more broadly. Okay, now in terms of the mechanism, here I have some questions. Because, this is a popular explanation, and which I very much am sympathetic with, that the TFP comes from these R&D investments. And sort of the recent reference is Antonin Diaz and Surico, who do indeed show that there are long-run gains from military spending through R&D in the form of productivity growth. So you can see there what happens to TFP. It kind of permanently increases, and you can see that patenting eventually increases. But these things are, these things take time. It's not that, we we announce some defense spending now, and all of a sudden we have R&D and TFP, and all of this is happening, this quarter. And so while that is a plausible possible mechanism for maybe medium-term productivity, it seems to me a little too much to ask for it to show up in the data almost contemporaneous to the announcement. In my own work, this actually should be 2024 from a paper I published last year, I look at learning by doing in US aircraft production during the Second World War. And what you see on the left-hand panel is what happens in response. And there are a lot of these learning by doing papers, but they were written in the 50s, just showing correlations. I try to be more careful about the causal identification. I won't get into the details of that. But what you can see on the left is what happens to TFP in an aircraft manufacturing plant that receives more orders for its product relative to other plants that saw a shift in demand away from them. And you can see that TFP does grow, and these are, up there it's quarters, down here it's months. And you see that within the first year, you're already seeing these learning by doing effects. You're seeing TFP growing by about 1/3% within the first year. And it appears persistent, at least, within those 2 years. On the right-hand panel, what we're seeing is kind of the mechanism of the mechanism here, is that the effect is substantially larger in plants that were initially, at the beginning of the war, already operating at high levels of capacity utilization. That is, many hours per worker and high utilization of capital. And you can see that they see greater TFP gains. And what I document in the paper is that indeed what happens here, that might sound surprising. The firms that are most struggling to produce see more productivity growth. I call this phenomenon learning by necessity. The fact that you receive more demand and you're already operating at your capacity constraints, and that's the moment at which you say, okay, there are these new technologies to adopt to improve my production techniques. I bear the fixed cost to kind of upgrade my technologies to be able to mass produce. Kind of as an aside for European policymakers, I'm hearing a lot, does Europe have the capacity to do this? Are we not at full employment? Can we do this? And I think our capacity is not limited by what static view we have of our capacity to produce. We need to think a little bit more dynamically about what will happen. Okay, but coming back to Evie's paper, as I said, I mean, maybe in a self-interested way, I believe that the mechanism is more likely to be, in the short run, through a learning by doing effect than by a R&D that is more lagged. But even relative to what I document, this seems a little too fast. I mean, to have a TFP, so we're looking at a shock to future defense, a news of future defense spending. Defense spending itself has not increased. Defense production lags defense spending, okay? And now we see immediately a TFP response. So conceptually, what has to happen here for this to be the response to the news of defense spending is that somehow non-defense producers are becoming more productive now because somehow of news of future defense production. Indeed, this may happen in dual-use corporations, but again, I think the mechanism is a little bit slippery here, and I would want to kind of understand a little bit better how this is happening so quickly. And so, yeah, so this, I think it's something that needs to be investigated a little more and kind of trying to piece away, maybe with sectoral data, understanding where the TFP gains are coming, et cetera. So I think just documenting more carefully the mechanism of the mechanism. The second comment I have, somehow the title of the slide should say comments to the puzzling real wage response, is that the real wage is responding in a way that it's very, very hard for me to find the theory that would deliver this response, okay? So if the mechanism, okay, so to get large consumption responses, let's forget TFP for a moment. But if we thought TFP wasn't responding, a model in which consumption is going up, there's some kind of Keynesian mechanism going on there. These type of Keynesian mechanisms usually are associated with increased labor demand. But what we're seeing here is higher employment and lower wages, which seems like almost like a labor supply shock. So it's hard to understand how you would get large multipliers, but also a decline, or such large multipliers, but also a decline in the real wage. Now, it becomes even more puzzling when we think about the TFP response, because if TFP is going up, somehow the proceeds of that TFP is going to be distributed, roughly 2/3 to workers and a third to capital. You have to have like a really massive reallocation here for that TFP to harm workers' wages and not pass through at all to workers' wages. Somehow capital is becoming very productive, substitution from capital. So I mean, again, the mechanism here is unclear. What is the framework that would deliver a decline in real wages? So those are really my two main comments. I'm a bit reluctant, at this point in the conference to get into the weeds of econometrics, but I'll just kind of throw two comments here. The first comment is regarding the fixed effects in the specification. So currently there are country-specific fixed effects, but in a VAR you already are controlling for lags of all variables. So that country fixed effect is pretty much redundant because all the information about individual countries will already be absorbed into those lags. So I don't think the country fixed effects are really buying so much in terms of improving identification. There's also a technical point which the bias is usually very small, so I'm not going to kind of pick on that, but there's sort of the Nickel 1981 bias that you shouldn't have lag-dependent variable in the same regression as country fixed effects. But I mean, I do that too, so I'm not going to give you too much of a hard time on that. I get that comment all the time, so I'll pass it on to you. But I'm wondering, and maybe I'm kind of not understanding what is possible or impossible in this specific specification, but to include time fixed effects, and that is going to allow for identifying off of relative defense news in different countries. So for example, you don't identify off of the common effect of the end of the Cold War, which is confounded with a lot of other things, but you're identifying by the fact that Greece after the Cold War is increasing its military, while Germany after the Cold War is decreasing its military, but the common effects of the end of the Cold War might affect both those countries the same. So there might be some gains that can be made there. And then another, just again, almost throwaway comment is whether you can't, I think the same comment was on Roberto's paper, but whether it's possible to do this at quarterly frequency. I mean, it seemed, if I'm not mistaken, the only variable that really is restricting you to move to higher frequency is the defense spending. But defense spending is relatively slow moving, and so would it be terrible to interpolate to quarter? You have all this data at quarterly frequency, and would it be such a sin to interpolate the military data alone into quarterly and then be able to exploit the full high frequency of the data? But all these comments are in the context of this is a really useful and important paper, and I've definitely updated my priors updated my priors upward on the effects of defense spending on the European economy.
Thank you.
Yeah.
Okay, why don't we open up the floor? There's Francesco, Mario, Davide.
A very interesting paper. So I have a question on measurement. So there is a recent paper that probably Evie is aware of that is R&R DAR by Briganti and some other young authors that basically document that this news effect in Remy's work about news about G is driven by the fact that initially military spending, defense spending shows up in inventories. So that's for the United States. So I was wondering if there could be something going on about measurement also for European data. And the story goes that first when these orders, so companies start producing more and building up inventories, and then only later this gets registered as G shock, and much later, almost 2 years later. So I was wondering if this big jump in output that we see could, in principle, be driven by the same phenomenon.
I think Mario's first, then Davide, and we'll go back there, Eric, and Dimos.
Very, very interesting. The two questions is, one, I would have liked to know how different this would look if you had identified the news about G as opposed to defense spending. And, it would be interesting if they are different, given our priors about how different types of spending matter. The other is, in terms of the identification, understand that you try to control for some other shocks driving output. But we know technology shocks and commodity prices are not main drivers of the business cycle. And the impulse responses you get for consumption, output, and even TFP is not utilization, it's just TFP. So basically, we're seeing utilization moving in the high frequency when we see this. But it looks very much with the same shock you would get if you had identified the max share to output. So my question would be if, no? Okay. My question would be if you were to first purge out for the movements in output and then look. And again, it's tricky what we're identifying from that, but that would also be informative.
Yeah, thank you. Davide?
No, very nice paper. 2 comments. One is about the identification of the shocks. I think in Europe, I tend to believe that actually defense can be endogenous, and actually we see now that it's been endogenous to country-specific conditions and time varying. So for example, even now, you have like a domestic escape clause that has been relaxed, and the countries that actually are planning to do more are those that have a larger fiscal space, while countries that have lower fiscal space, they are not doing. So there could be a situation where, yes, countries, they would like to do defense spending for non-economic reason, but whether they ultimately do and how much they do, that depends on several factors, including economic conditions, fiscal space, etc. The second is about assuming that the shock is really like a defense shocks, you show that geopolitical risk increase. So to me, this means that the exclusion restriction is not satisfied. So what you are capturing is not the effect of defense, but it could be the effect of defense news that move defense, yes, but also move geopolitical risk, which has a direct impact on economic activity by increasing uncertainty and others. If this channel is at works, it actually may sort of tone down some of the direct effect, because assuming that the geopolitical risk and geopolitical uncertainty has a negative effect on output, by controlling for this channel actually should get even a larger effect. And third, on the TFP, indeed, if you try to use, we are doing a similar work. If you try to use a cyclical adjusted measure of TFP, what you see is like it's completely flat and it doesn't move much. Even after 5 years, the responses are very, very small. But very nice paper.
Thank you. I think Eric, it was Eric next. Yes. And then Heike.
Yeah, so thanks for the great presentation. So one question on TFP. So I guess it's revenue TFP. So it can be either, the rise in TFP can be either a rise in markups or a rise in TFPQ. I have the impression that at least in the short run, it can be a rise in markups, and which would be consistent with the drop in the labor share. So could you say anything on this?
That's a good point. One more question here, and then Demos. Sorry.
Thanks. Also, very nice presentation and discussion. My question is, I mean, if I would take your multiplier of around 2, but then when you compare most of economic forecasters recently, when they looked at, say, Germany or some other countries, I mean, like the gross dividend has not been very high in their, forecast update. So just trying to square what you find in terms of your in your multiplier vis-a-vis what economic forecasters are actually seeing on the ground right now. Thank you.
One last question by Demos.
Thank you very much. Very interesting presentation and discussion. Maybe I've missed it, but I think there is one very significant difference when it comes to TFP, the impact on the labor market, especially when it comes to news and how these translate into the economy, which is the specific economy one is thinking about, Greece versus Germany, for example, or the US. An exporter of or an importer, because military spending, unlike other government spending, probably is much more, prone to leakage, if you want to call it that. So, would that be? Is it better to put that, incorporate that kind of distinction in the data itself, or maybe in the model? Thanks.
Thank you. Back to you, Evie.
Oh, thank you so much. So first of all, I would like to thank you because, I thought that you would tell me, okay, now let's go. So, and you're asking so many questions. That means that I really appreciate. So let me start thanking Ethan for his discussion and for his nice words. So the immediate TFP responses is something that bothered us at first sight before even we did these orthogonalizations. So the issue is that we cannot impose into data things do not happen. We're going to be subject to Lucas critique. TFP is an endogenous variable if we think about it. That's why we do the orthogonalization with respect to utilization adjusted TFP when we look at the big 5. So instead, what we have done to try to look to see if this TFP is coming from something else is to kill the pattern responses that we would think that they are more exogenous, and the results we're going through. So, and the patterns were indeed increasing with a lag. So I will connect this to Eric's points, and thank you very much. It could be related to mostly to markups rather than actually anything else. Now, regarding the real wage response, I think that there's a complete section in the paper where we explain, because you see, Nadav is a purist. So he said, if we are going to use the Ameco series, we will use them for everything, okay? So the real wages of Ameco are deflated with a different way than if you would take other real wage series and you deflate with GDP deflators. So if we deflate with GDP deflator, wages go up. So there is something wrong with the data series, but he said that it would be suspicious if we use one series for one thing and the other for the other. So we put the explanation there in the paper. Now, regarding country-specific trends, we have thought about it. Not time-fixed effects, I don't think they're needed, but time-specific trends we did. Now, another thing that I would like you to appreciate that I didn't really talk about it a lot is about this nickel bias. We have 50 years of data, so nickel bias is 1/T, it goes away. So the bigger is T, the better. So we kind of deal with that by looking at this long annual data. Now, as I said before, Nadav is a purist. If I would tell him to do interpolation, he would kill me. He would not accept that, it's no way. I don't know if he listens to me there, Nadav. It's true. So we have to do the maximum we can with the tools that we have. So I wouldn't like to interpolate. I can tell you That's a very good comment, Francesco. Thank you for inventories. Actually, I don't know about the paper of Brigandi, so I better do. And actually, we can look, I think we can find data on inventories and see how they change. But the beauty of what we're doing is, like, you see, we are very agnostic. So maybe, you know, we recover these shocks. Maybe it comes from the inventory mechanism, and that's why the immediate TFP response. So I think that you tried to help me, and thank you. I'll have to look at this data. Marios, I like very much your suggestion. We have tried, actually, to look at the share that maximizes the FEV of output in the future, like in your paper with Fabrice and Harris. Thank you. Like the responses do not look the same. I need to say two more things because, like, they ask a lot of questions, and I don't want them to think that I didn't. So, like Davide, for example. Yes, we do think about the fiscal space, and yes, Demosthenes, we do think about the heterogeneity that I didn't present you here. We do think about these things, and we try to account for them. And actually, it is true. If I look at the multipliers for countries that they are military producers, like France, Italy, Germany, the multiplier is higher than it is for Greece. Like, I think it makes sense. And also, fiscal space here also matters. Like, I understand that there could be political factors or support or whatever, but I wouldn't, that would affect defense spending, but I wouldn't think that we are in the condition in Europe like in the US, in the sense that, okay, we have a recession, why don't we go to Venezuela and try to get rid of somebody? You know, I don't think we have this, case in Europe. Here, I think most of the defense spending that has been done historically was for some good reason. I don't think it was to avoid the recession or something. So I wouldn't think that this is the case. So I want to leave it here. The GPR index increases, so exactly output according to Iacoviello should fall in Caldara. For us, output is increasing, so for me this is encouraging that I'm doing something right. So thank you for this comment, and thank you all very much. And more than anything, thank the organizer for inviting us all, and this was a very helpful and insightful conference, and I wish you all well to do more than that.